Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Torsten Slok of Apollo got two benefits there. One, he got an extra 12 minutes to go over all of this, and two, Mike McKee set him up perfectly because, Torsten, you just sat there nodding. You agree, don't you?
100%. I mean, let's look at the numbers. Non-farm payrolls in August was better than in July. The unemployment rate in August was better than in July. Average hourly earnings higher than in July. And you look at average weekly hours, also better than in July. I mean, this report is better than in July. This economy is not slowing down in the way that markets are anticipating. We will not get 8 cuts over the next 12 months. Here you should instead look at this report as this is really telling you that there is a soft landing.
So help me with this. In October, when we look back at this report and we get another revision, a downward revision, don't we have to reframe some of this conversation and just say everything keeps getting revised lower? This is Lisa's point over the last few days. This economy, this labour market is weaker than we initially thought it was.
But GDP in the second quarter was 3%. It was just revised up. Jobless claims continues to be good. Continuing claims was also good. If you look at the daily data for how many people go to restaurants, how many people fly in airplanes, the weekly data from Redbook on retail sales, if you look across the board on bankruptcies, if you look across the board on credit card spending, in the aggregate, the growth data is just not showing signs of a slowdown. It is true that the labor market is weakening, and yes, the JOLTS data has been a little bit, maybe more in balance, as the Fed would be saying. But this whole notion that the economy is slowing down rapidly, it is completely misguided.
What I thought was fascinating, I was speaking to a number of retail executives at this conference this week, and their biggest question was, what's going to happen with the consumer? They didn't know. They had zero visibility. Even though you are seeing some trends, some signs of robustness, some signs of weakness, they said ultimately it just depends on whether they have the money to spend. These labor market reports are raising a red flag for a lot of people, saying if they lose their jobs, they won't. How fragile is that sort of happiness that you're describing to a scenario like that?
Certainly, if we do have a rise in the unemployment rate, so that's not what happened, the unemployment rate went down, it would become a problem. But if you also, exactly as you know too well, look at what they did say, the retailers, during this earnings season. Target said no sign of a slowdown, Walmart, no sign of a slowdown, and also Costco, no sign of a slowdown. You saw Dollar General, some parts of consumers are under more distress, but broadly speaking, looking at retail sales, both the monthly, the weekly, and across the board on credit card data, there is just no sign of a sharp slowdown. So the bottom line in this discussion is that you only get a recession when you have a really big shock to the economy. And that makes sense, of course, with COVID, Lehman Brothers going under, of course, the bust of the IT bubble in 2000. But this is not an exogenous shock with something coming from the outside. This is all engineered by the Fed trying to slow things down. And now the Fed is telling us that they're about to lower rates. So that's about to counter some of those negative things
that have
been weighing on the economy.
We get another headline from the Federal Reserve. Mike McKee from the New York Fed President, John Williams.
Yeah, John Williams is saying it is time now to join the party. He is not commenting in his prepared remarks about today's numbers. Of course, he wouldn't have had them ahead of time. But he does say it's time to cut rates. With the economy now in equipoise, which he titled his speech, that means in balance, and inflation on a path to 2%, it is now appropriate to dial down the degree of restrictiveness in the stance of policy by reducing the target range for the federal funds rate. So the guy who's vice chairman of the Open Market Committee is saying we're going to cut rates. He's not yet talking about by how much, but there is a Q&A, so we'll keep an eye on that.
And apparently owns a thesaurus, too, over at the New York Fed. Torsten Slok, what do you make of that, and what are you looking for from Governor Waller?
So I do think Waller will also give some more guidance in terms of what's going on, at least with the bigger economic picture. But I don't think that he will tell us much about whether this is 25 or 50. It requires probably a very important debate, given the spectrum of where FOMC members have been recently in their speeches. Some are clearly saying, some are even suggesting we should have much fewer cuts over the next several quarters. And others, of course, are suggesting that we should go much faster. So I do think that they need to gather in the room and think hard about, do we want to go towards 25 or 50? I would say, and I would agree with Mike, that 25 is the right number, given that literally everything in this report was better than in July.
Would it be a policy error, though, to go by 50?
See, that opens up the debate about our star and how far do we need to go down. If our star and where we need to go to, and ultimately, so real rates plus inflation, if we only need to go to 4.5, we're not far away from that, so there's no rush to lower rates. If we do need to go all the way down to 2.5 or 3, then there is certainly more of a rush. But given the incoming data across the board is still good, why is there this rush to cut rates so dramatically, other than the R-star framework, which says that we got to get going?
Jackson Hole's speech was all about understanding the effect that Fed policy has on the overall economy. The conclusion was we still don't know. We don't have a sense of exactly how quickly it gets sort of transmitted and how much of the lag effects that we're starting to see. There is an argument if you cut rates more aggressively now, you can get ahead of some of the lag effects that we haven't yet even seen. Why don't you give credence to that?
Because there are three very important reasons why we did not get that slowdown that we all anticipated for so long throughout 2023. Remember, they started hiking rates in March of 2022. First of all, consumers and firms had locked in low interest rates. AI investment has been very strong, and fiscal policy has been a huge tailwind. All these things combined have been the key reason why the economy has not slowed down. And those things are actually still in place. A lot of people still, of course, have low interest rates in mortgages, in investment grade credit, fixed rate, also very locked in for a long time. So that means that if you do start cutting rates, it's actually the transmission is also going to be weaker on the downside. It was weak when you were raising rates. It's also weak when you're cutting rates. So because of that, AI investment still strong. Fiscal policy from CHIPS Act, Inflation Reduction Act, and Infrastructure Act still strong. All this argues that the data will just continue to be steady over the next several quarters. There is no reason to expect this to be a hard landing. There is no exogenous shock similar to what we have seen during previous recessions.
Torsten, can we go back to the revision for a second? If you take off the 25,000 we took off last month and you do here for August, you'd get 117. Would you still feel this way if it printed 117?
Sure. Of course, the revisions are very important because we have seen some modest slowdown, but broadly speaking, the data was still better than what it was in July. So taken as the overall picture of, in particular with the unemployment rate, which is especially important when you put that into your Taylor rules and try to figure out what should the reaction function be from the Fed. And that's how all the regional Feds prepare the forecast. And if the unemployment rate goes down, it's hard to argue why they should be going 50. To go 50, you need some very, academic argument about our star, and you gotta get going with lowering rates very, very quickly. And the question is, with the incoming data being so strong, is monetary policy really so restrictive? It doesn't look like it's restrictive. If it was really restrictive, the employment report would be a lot weaker.
Pause, because this is exactly where I wanted to finish with you. You're saying 550 is still not that restrictive for this economy?
So if our star, if where we're going, the terminal rate is 4.5, is 5.5 far away from 4.5? I know we, have been somewhat, not quite brainwashed, but very distorted by a lot of FOMC members continuously saying we got to normalize rates, normalize rates, normalize rates. But let me ask you this, John. If we really had restrictive monetary policy, why have we for 2.5 years and counting still been getting very good economic data, including GDP in the second quarter at 3%?
The lags are just longer. They might say the lags are just long.
What should be the reason for that? The tailwinds from AI continue to be strong. The tailwinds from fiscal policy is still strong. We have locked in low interest rates for the consumer and for corporates. Where is this very significant transmission of monetary policy?
When we sit here and do this again a year from now, we'll do it before then, don't worry. In 12 months' time, where do you think rates are? They've got a 4 handle, they've still got a 5?
I think that they will be much higher than what the market is pricing at the moment because this is not a shock that is generating a recession. Why haven't we had a recession for now 36 months and counting? I mean, it is really the case that the economy and the economic data has just been much better than what literally any model would have predicted for the reasons that I just mentioned, namely locked in low interest rates, tailwinds from fiscal policy, and AI spending being completely independent of whatever the Fed is doing.
This is box office, and we should do it again next week. Torsten Slok,
I'm ready next month.
Looking forward to it. Torsten Slok of Apollo, thank you very much. In the commercial break, we were debating with Jeff Rosenberg of BlackRock what would be the most confusing labour market report today for the Federal Reserve and for market participants. And Jeff said something like, if you got a slightly softer jobs report, but unemployment actually dropped back from 4.3 to, say, 4.2. And Jeff, we got a mix. That's the mix we've got. So Jeff Rosenberg of BlackRock. Jeff, please make sense of this for us.
Yeah, tough to make sense of it. It's a bit of that mixture. But I think the headline reaction is to the slightly weaker payroll headline. and the revisions, as Lisa was pointing out. So it's a little bit weaker on margin. The bond market is very much behaving as if, if we price it, they will cut. And so increasing the probability or trying to push the probability to 50. I don't think this report is definitive on the 25 versus 50. I think it's going to be Waller.
What do you want from Governor Waller, Jeff, at 11 a.m. Eastern Time? What are you looking for? You think that's the final voice that sets up whether we go 25 or 50?
I think it is. I mean, I think it's set up on the calendar to give markets clarity on what the Fed's going to do. He will have had the information. He would have had a chance to talk to Powell. And so that you don't get a big market reaction, not next Wednesday, but the 18th when the FOMC meets. So I think it is intended to, provide a little bit of a steer to the market. So I think that's going to be, as important as the number that just dropped, what we get in terms of the reaction. And it's hard to say, which way they go. I think, the market is pushing for 50. This number isn't, particularly weak. You have the potential of the first print bias lower on the headline. Maybe that gets revised, up. We're talking about revisions. This is a weirdness in the data where August tends to be weaker. There's a slowing and there's an argument, on both sides. If they do 50, does that, kind of signal too much concern? They can talk around that. They can talk about 50 and talk about their confidence in the economy and kind of ease some of that concern. So the market has been kind of right in the middle between the two. This morning, I think it's really just about that revisions and a little bit weaker relative to the expectations and consensus around 165, coming in a little bit below that.
As an investor, what's your response mechanism to a Fed that signals 50 basis points of a rate cut? Is it basically just extrapolating out about 150 basis points of cuts this year, and that essentially that's going to be questionable for risk assets? Or do you say this is supportive because this means that they're going to adjust quickly back to something that the market thinks is more neutral?
Yeah, we had that debate yesterday. I think it's a tough one. Typically when the Fed cuts 50, they're cutting 50 because there's a growing deceleration in the economic data. This is a tricky period because you obviously have a lot of focus on the labor markets and the labor market deceleration as being the leading indicator. It's not really a leading indicator. It's kind of coincident. Some measures are lagging. The rest of the economy looks strong, but there's this fear that the Fed is behind the curve and that the rest of the slowdown is coming, and the rise in terms of kind of hard landing fears. And so 50 might, kind of push people along that direction. So it's more negative rather than the Fed's kind of on the job. It's, the Fed's behind the curve. The 50 basis points validates our fear. And then you have all the other issues in terms of, risks, high valuations, concentration in terms of valuation in the tech sector, all kind of leading to a lot of angst. And then even what we saw last month, in terms of the outsized market reaction, positioning I'm talking about August 2nd and August 5th. So I think the risk here is that 50 could be more of a negative signal than a reassuring signal that the Fed's on the case. But yeah, it's a tough call either way. Well,
you were having the debate yesterday, Jeff, not just the market more broadly. What would your reaction be given the fact that the Fed doesn't have proprietary data that we don't see that points to a more conclusive signal about where this economy is headed?
Yeah, it's really about the Fed's shift. We saw it from Jackson Hole and Powell, and it's shifted this whole narrative focus and really market reaction focus onto the growth data away from the inflation data. And that shift means the Fed is worried now more about securing the benefits of their past policy intervention to secure the benefits of reducing inflation, and now focusing on securing the soft landing. So all of any signals around their sensitivity, any validation of that in terms of the data, makes people very much on edge that you're, back not to the what Powell called the era of flouted rules, that, you can't rely on these rules like the SOM rule, like labor market differentials and other things that people point to when you have recession signals, that those may actually in this time, be the right signal. And that kind of concern that you see in many commentary, many forecasts, gets more validated under a 50 basis point cut scenario. And I think that's the concern. That would be, the pushback. They can signal around that. They can use the language. They can use the press conference to manage that. But it's a tricky needle to thread.
Hey, Jeff, this was great. Jeff Rosenberg of BlackRock. So here's the latest. Donald Trump promising to use tariffs as an economic weapon in a potential second term. His remarks coming ahead of Tuesday's debate with Vice President Kamala Harris. Michael Zezas of Morgan Stanley writing the following. Tariffs could pressure economic growth, but possibly more so outside the U.S., potentially driving more dovish central bank policies overseas than at the Federal Reserve. Michael joins us for more. Michael, good morning.
Hey, good morning.
That's a thoughtful take on a situation for global central banks. Do you think some of those policies could be more damaging to countries abroad than maybe domestically?
Yeah, well, listen, if you think about the U.S.'s posture in terms of its trade relationships with the rest of the world, if it's tariffing more of its imports, then the more the pressure is going to be overseas. So this often comes up in the context of what does it mean for the dollar, right? And the Trump campaigns talked about the desire to have a weaker dollar, but some of these policies we think at least initially would manifest in a stronger dollar because it's putting more pressure on the rest of the world, then the central bank dovishness you'd see overseas would outweigh what it would do to the U.S.
Most people talk about also in the context of what it means for U.S. consumers. But if you look at the rest of the world, who would win in that scenario?
Well, I think it's complicated to say that there are specific kind of winners and losers. What I'd say is if over the long term, if the U.S. is pursuing more protectionist policies in the aggregate, which it probably is regardless of who's president, it's just a matter of tactics. Republicans clearly want to lean more on tariffs. But what it does is create this long-term incentive towards nearshoring, reshoring, et cetera. And the places that are best set up for that, I think, are the ones that we know for the most part, right? Mexico, if you go into Asia, we're talking about Vietnam or maybe Turkey and MENA, because these are areas where you have to kind of recreate the labor supply and the labor cost elements that you have in China, but you can't do it in one place. You have to, if you're a multinational, you have to kind of do it in the aggregate in the multiple different places.
You have a hard job, especially at a time where people are saying it's basically a toss-up and nobody really knows what's going to happen, and people are coming to you to explain what's going to happen, and you say, I have no clue. But I am curious about whether it's getting easier in this one sense. The two parties are kind of coming to the same place. That increasingly it looks like the policies are very similar to one another, and you just talked about how there are going to be protectionist policies no matter what. Is there a baseline of how much this gets accelerated regardless of whether it's Harris or Trump?
Yeah, I mean, so again, if we're talking about trade, the real difference is in the short term on whether or not you're using tariffs, right? And if that's true, then the real difference in 2025 is, are we pursuing trade protectionist policies that have tariffs or don't? The end state might be very much the same, but in the short term, the tactic of using tariffs just creates a lot more volatility and a lot more uncertainty around growth. And then to the extent that you've got a Republican pursuing those policies, maybe they're going to deliver something on the back end in 2026 that's helpful to the economy in terms of greater fiscal expansion. But the sequencing here is important because you might very well go through the tougher, more risky stuff up front.
And then you want to talk about corporate taxes. Now, we can have the tariff conversation. It's a bit easier because we don't have to talk about the makeup of Congress when it comes to taxes. We do. Let's talk about how workable things are. Yeah. Harris is saying take things from 21 to 28. Trump is saying take things from 21 down to 15, but with a lot of conditions. Yeah. I imagine you fielded a lot of calls yesterday from clients. What did you tell them about how workable the Trump plan is for a corporate tax cut?
I mean, the workability of any of this is really a function more of politics than anything else, right? At the end of the day, all of these tax plans are going to have to pass through a budget reconciliation process that in some ways starts with party leadership deciding what number on the deficit expansion are they comfortable with, and then everything kind of fits inside of that. That's effectively what happened with the Tax Cuts and Jobs Act in the negotiation in 2017, where Senator Corker said we can do $1.5 trillion on the deficit, and then everything kind of fit in from there. So I think these proposals are important to talk about, and we have to pencil in assumptions for them. But how workable is 28% on cap gains as opposed to something higher? Well, that's really a function of what does the party decide in the aggregate they're willing to do on the deficit, and then therefore what is it they feel like they need to pay for and what levers they have to pull from there.
There's a ton of proposals that are coming out of both sides, exempting on Social Security taxes, expanding child tax credit, which seems that both individuals want to do. What do you think is your base case actually gets done if we have a divided government?
Well, in a divided government, I think you can expect at least some of the kind of commonly supported provisions that are set to expire instead of the Tax Cuts and Jobs Act get extended. And then mostly kind of everything else goes to the wayside. So when we add up what we think are kind of commonly accepted provisions, it adds up to about $1 trillion of incremental deficit expansion over 10 years starting in 2026. That's where we think the bipartisan angle is. If Republicans sweep, we think that number can get as high as $1.6 trillion. If Democrats sweep because they'd be more willing to bring new revenue to the table on the tax side, that number could be like 500 to 700 billion instead. So really, I think we have to think more in terms of kind of the values and the principles each party is bringing to the table. The precision on the numbers is going to follow later after we get more details.
Okay, but I want to build on this, though.
Yeah.
And this is what we were talking about with Tobias Marcus, too. I mean, we talk about the lack of clarity around some of these numbers that we get and the details that are yet to be worked out. And yet, House after House has come out and said that Trump is going to increase the deficit more than Kamala Harris.
Yeah.
We have a number of Republican strategists as well as people who could be his advisors who come on the show and get very angry. And they tell us that we're not accounting for growth that will come on the heels of some of these tax cuts, et cetera. What's the argument against that? Why is that not being included in any of this?
Well, okay, I think there's kind of there's a technical argument and then there's a more speculative argument. The technical argument is that the way the government's going to score in any of these things typically is not going to account for incremental growth or dynamic scoring, as they like to call it. And so investors kind of not having certainty on that, particularly bond market investors, are really going to project or sort of discount to the present what is the expected deficit projection that the government is telling them. That's going to factor into supply. And so the idea of sort of future economic growth kind of mitigating that deficit impact to like T plus 2, 3, 4, or 5 years later feels quite speculative, and it's not something that you can work with from an investment perspective.
Bank of America this morning said the most important NFP and most important debate of the year. That's what we're waiting for. The debate's important because we still don't know all of Kamala Harris's policy proposals. What are you most interested in trying to understand from her economic plans?
Yeah, I mean, I would love to hear more precision on both the tax and the spending side. I don't think you're going to get more of that from either candidate, though. And campaigns a lot of times are about putting your values out and expressing them in statements as opposed to specific policies, because that's going to be more persuasive to voters. So I'm obviously going to watch carefully what happens on the debate stage next week. I personally have low expectations for us learning more precisely what each candidate wants to do.
Have you developed much of a sector focus just yet, or is it still too early?
Well, I think there are some sectors that clearly sort of benefit or benefit less in either outcome. To the extent Democrats have more control, a lot of the sectors that benefit from the IRA, particularly clean tech, are going to be more secure because that spending is going to be more secure. If you have Republican sweep and therefore more of a skew towards extending more of those tax cuts, that skews more towards domestic industries, a little more towards small cap. I think it's one of the reasons that when it looked like Trump win probabilities were going a lot higher following the June debate, you started to see signs of life in small caps, and that's kind of come back as things have gone to more of a toss-up.
This is what Dan Greenhouse said yesterday on this program. Yeah,
essentially that when you start to look underneath the hood, and this is what we heard also from Trump's potential advisor, that they're going to freeze some of that funding for the IRA, and that could end up really hurting particular areas, which is the reason why you're seeing some sort of shifting around the candidates.
To speak almost exclusively for the investor class, I think the way they view things at the moment is that Harris needs Congress to do some of the bad stuff, hike corporate taxes. Trump doesn't need Congress to do some of the bad stuff. He needs Congress to do some of the good stuff to offset the tariffs. So ultimately, I think the things as they stand are Harris needs a sweep, and that means that's bad for markets. And if Trump doesn't get a sweep, that's also bad for markets. Fair enough?
Sure. I mean, I think that right now, what I find most interesting is that regardless of whether that's good for markets or bad for markets, it's when it will be good for markets or bad for markets. And the fact that Michael Zezas is saying that essentially the sweeteners will come later because it will take longer, to me is indicative of, will the Trump trade look different this time around?
Mike, this was great. It's good to see you, sir. Complex stuff. Mike Zezas there of Morgan Stanley.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.